Righto, buddy miners. The Q&A episode that was asked for a couple of weeks ago.
It's here.
It's here, and who better to bloody be the partner for it than Saltbush Contracting?
Doesn't
that just make sense? The turnkey, bulk haulage, site support, they handle everything once you mine the ore, GC.
Yeah, once that ore's out, they'll look after everything for you.
Right, anything you want, they will polish the ore for you. And just remember, when a job is too hard on your mine site, you get fucking Saltbush to do it. That is the saying you should have in your head, whether it's building a road, bloody mine rehab, equipment hire. Why buy it when you can get some off Saltbush? Go Saltbush.
Well done, Saltbush.
And do you remember the questions for this? Bloody while ago.
Yeah, no, there was a bit. We had a little bit on, I remember we talked about copper, we talked a little bit about Indonesian mining. I think we talked about orebody geometry.
Oh,
I learned a lot about that.
Yes.
That was cool.
The intricacies of what's a good and bad geometry for underground
and
mining.
Plunge and all these fancy words. There was actually some finance lingo as well for the non-financy people too.
I'm devastated that there was a lot of macro stuff, and it's 2 weeks too early because, like, I am now a macro guru after the Trump stuff, and I feel like I'm not going to be reflected accurately in this video to what my prowess is at the moment, but I'm happy to wear that. So,
been a good learning curve in the last 2 weeks, hasn't it?
Right, let's get into the Q&A. Or we could just talk about K-Drill. That's got you on the chapters there, didn't I? Not just an RC and diamond drilling company, GC. Drilling the holes is the easy part in exploration. It's creating the K-Drill culture that the bloody drillers want to work for, that the offsiders want to sweat their guts out for, and who else to do it for than Rhino Sullivan? He is the man that people want to work for.
And especially in this WA heat we've been experiencing this summer, so far. I mean, that's a lot of sweat.
Mate, you wouldn't do it for anyone. No. But, like, the only way to possibly become as good of a driller, a manager, and a bloke as Rhino Sullivan is to work for Rhino Sullivan. You might get close if you're exposed to him. Just go help K-Drill, keep the mining industry alive. RC and diamond experts.
Go K-Drill.
And just people experts. Righto, we'll get into it now. Righto, Matty miners. We asked, you asked, and we're about to answer. That was the process. We asked for Q&A. You have given us Q&A. GC's going to run a Q&A.
That's it.
So, how good's that?
No, thanks to all the money miners that submitted a whole bunch of different questions to us during the week. Thank you for that. I've taken the time to whittled them down to a few that we're going to ask the team, all sorts of topics and companies, commodities, just shit that's happening in general.
Please tell me there was a question about your stock holdings.
You know what? There wasn't, and I'm so glad. That gets talked about enough.
Ali's got all the power, though. We wouldn't even know.
I've got to go back through and check those.
You've intentionally withheld these questions from us, so we're
yes, and so you guys haven't seen the questions, so it'll be your first crack at them. So
this exposes me, jeez.
No, you'll be all right. You'll be all right.
We can still edit the video. It's all good.
Yeah, true. Thank fuck for that.
So let's kick things off. So we had James and Aisha from Twitter who asked about, and actually a few others who asked about what you guys think about the outlook for copper in the sort of near term. And, James also asked about, there's, not too many pure play copper plays left on the ASX. What were you guys' thoughts just on that, and then the copper more generally for this year?
She's pretty consensus long, right? Like that's the feature of it that kind of scares me in a way, that everyone wants it, especially, you have the mining sort of fundies, and then you have the generalist as well. And when every man and their dog loves something, you're not going to get it cheap. And you see it in all the transactions. There's been some hot M&A deals, big mines, many billions of dollars. And when you have that many people looking at that many miners looking at the transactions, because every big miner wants copper, you're not getting them cheap. So you're really paying for that narrative, as opposed to buying something that's deep into the cost curve, where you might be getting it on a discount because everyone hates it and everyone's running away That's the sort of first thought that comes to my mind.
Well, on the big scale, it's like Big Trumpy's going to have a massive effect on China, growth of China, and because China is the determinant on what copper demand's going to be, and if there's any slowing there, that's obviously you can pick the best stock you want, but if the underlying price doesn't go up, good for bloody bugger all. So, but then on the pure getting pure play of scale as well, like AIC for instance, it's pure play copper, but it's not producing shitloads of copper. Develop with Woodlawn and that, they're not going to be big, they're not going to be at 50,000 tonnes of copper.
Yeah.
Whereas Mac, they're
45,000,
40,
trying to get over 50.
Yeah, so it's like trying to find something of scale in here without going to going to the Vicuña, to a porphyry or something that requires bloody shite loads of capex.
The lack of copper ASX names is reflective of the lack of quality in ASX in Australian copper projects.
Yeah, you think I remember
scale at least.
Well,
anyway.
DeGrussa was what were they, 65,000 tonnes of copper, because it was 1.6 million tonne at near 5% copper. But to find that now, look at $500 million company, Firefly, that's probably going to be 1.5% copper. So that'd have to be to get that to 50,000 tonne of copper equivalent, over 3 million tonnes of ore from a kilometre down. So it's to find that. Whereas, Mac is coming from 1.8 kilometres down, but that's got the grade. It's got 5%.
Yeah.
So
that was a distressed asset for a reason.
Yeah. So
near-term outlook for copper, probably about the same as where it is right now.
Yeah.
And I think you're better off, like you said, it's the corporates who are maybe getting looking on the outlook and saying there's a shortage, and so they're paying high multiples for the acquisition targets. To a bit of a tip to the person who asked the question, those acquisition targets are not on the ASX. Listen to that episode with Tom Ulrich, and he'll talk about maybe some of the other kind of targets that could get gobbled up, but they're by far and above skewed towards the North American listings.
North America. And a bit of this is another question, but sort of related topic. This was from Risk It for the Biscuit on Twitter. I'm not sure if it's a he or a she. Anthony. Sorry, Anthony. So I've just seen the name there. Will 2025 be the year that the small, medium Mount Isa copper projects start to gain mainstream attention and traction? One example is Glencore committing to a long-term partnership with Carnaby.
Partnership's a funny word, isn't it? you love to see the juniors use the word partnership with the commodity trading houses, but there's always a bit more devil in the detail there, Al.
Glencore are rather on the way out than on the way into Mount Isa. That's hard to sort of think about their approach to that area. So I think you're hoping for a few things to go your way. At the end of the day, they're higher cost assets, and if the copper price goes up, they've got a lot of torque to the price, but they are higher cost, and you're running the risk when you own them.
Yeah, what would Glencore sell the smelter for and all that there Mount Isa exposure?
What's the liability?
Don't know.
I couldn't tell you I wouldn't know. It's a tough one.
So you pretty much need some big dog to come in and consolidate the whole region, because it appears, as you said, Glencore's on the way out, so they don't want to do it. It's like, who will do it? Yeah,
Glencore are conscious of their social license as well. They've still got enormous economic activity in relation to the coal mining in that state. They don't want to, they want to preserve their social license in Queensland too. So,
no, that's a good point. Bit of a change of tack. So I'll direct this to our finance gurus, Trav and JD. So Hankler Go-Go, up and rising star up and coming here. So Hankler Go-Go from Twitter says, can you guys go over the terminology related to the ways of valuing companies, like a back to basics for some of the new money miners? Now, I mean, a segment like this, you could go on for hours, but why do we do a couple like MPV? What the hell's MPV for a very like any intro to finance?
I could zoom out a bit, and I would like preface it with saying the way you value, mining companies changes over time. You go from this in situ resource in the ground, and then hopefully blue sky discovery, people get ahead of themselves, and then as you get nearer and nearer to cash flow, people use the DCF. And whenever we're talking about these multiples, we often say stuff like PNAV. Well, we're sort of shortening things. It's price divided by the NAV per share, and that's what we mean by PNAV. And then NPV. NPV is a simple one. You're working out what is the net present value of the future cash flows from this from this mining project. What the NPV is kind of like a thing everyone looks at in the feasibility study or the PFS or even the scoping study or PEA. And what's your capex outlay at the beginning, and then what are your kind of free cash flows over time?
Taking into account the time value of money.
Exactly.
So that's why we always pick on the discount rate, which is the percentage you use to discount those cash flows. We talk pretty commonly, some other miners will reference EV to EBITDA multiple, which is taking into account the value of the company on the stock exchange, incorporating their net debt, and then comparing that with their EBITDA, which is a sort of crude cash flow metric. That's, we sometimes use it more often for copper miners and so on. It's more of an industrialist kind of metric. I think it's more preferred in the mining space to use net asset value, and that's related to these projects having a definitive mine life.
Yeah, plus the corporate level, there's often these adjustments for your NAV as well, being the cash and debt cap structure in the money options, which are reflected in NAV per share.
Yeah. IRR is another one
another one. Yep.
Bankers will chuck around, and that's just similarly when a study is being put forward, trying to just put your returns into a percentage term so you can understand what the returns might be, again, taking into account the outflows, the inflows of capital over time.
Yeah. I guess the interesting thing, which I think we touched on in a previous episode, is with mining assets, especially really long life ones, because things like NPV and IRRs take into account the time value of money. You might have a copper producer, a gold producer that produces for 50 years or something, but the NPV, because you're taking into account the time value of money, penalises, or it doesn't penalise, but it makes those cash flows that are 40, 50 years out so small, when actually, geez, if you can produce for 40, 50 years, that's like a great thing, but the Excel spreadsheet sort of doesn't give too much recognition for that.
Big time. The thing that Excel spreadsheet doesn't give you credit for is commodity markets are volatile. And relatively frequently there are these like short-term shortages and price flexes up massively. So, miners might just, wash their face for 7 years and then have 1 year where they make 7 years worth of profit because the price of their commodity shot up massively. That's like, you get in the realm of, where the spreadsheet kind of fails. It's just our assumptions on pricing and how volatile and, de minimis earnings can be for some periods and then highly lucrative for a very short period of time. That people talk about the NPV not capturing the option value of a mining asset or longevity that comes from enduring mining cycles.
Coal assets over the 2022 period is the most recent example of that, where prices go through the roof and these companies just buy back their shares, issue dividends and all sorts, and it pays for a lot of the bad years.
Yeah, no, I think there's some good things to sort of grains of salt to take in when you're looking at those sort of multiples and figures and things like that. Moving on, actually, you sort of touched on it before, Matty. Lots of questions about Trumpy coming in and what that means for commodities, commodity prices, things like that. I'll flash up a few of the questions that came through. Neil asked, the world of commodities in the context of the new Trump presidency, how does the team see this playing out in 2025? A couple other ones were predictions for renewable commodities with the cancellation of the EV mandate in the USA. Also, any insights regarding the drill, baby drill rhetoric in other jurisdictions, you say like Australia and Canada, how that may affect prices. I don't know if you guys had some high-level views on what that might look like this year.
Well, definitely, if you're an Aussie miner in Aussie dollars, you're definitely getting the good tailwind of an exchange rate at the moment. Like, going from within a quarter, it's gone from 69 to 62 cents. So if Trump's good for the US dollar, it's going to keep strengthening that and our realised price. But then it's, they talk about there's still a lot of gold buying around the world. I think the ETF flows have always seemed to, from what I've been told, of the US gold price movement have always outweighed the realised price that Australian miners get for it, just with the VNX funds and everything. So, but they'll, be in the position where look at Regis, they've got they're going to rapidly have nearly bloody a third to half of their friggin' EV in cash. So in a couple of years, so pretty phenomenal.
I'll be just like Metals X then.
Yeah.
If you look at other sort of policies, ones that we spoke about heaps over the past year and a bit, like the Inflation Reduction Act, IRA, talk that they might trim that down, can it? Who knows? I don't think a lot of that value or the benefits was really actually coming through, despite all the talk about it, to a lot of the miners. Regardless of that anyway, the US for EVs is like 10% of the global market. They're not, more than 50% of global sales are actually done in China for electric vehicles. So they're not a huge player in that market anyway. And who knows if they even, cancel it. Yeah. Remains to be seen. I think there will be shorter term volatile action as Trump and I guess his kind of competitors in a way, Xi Jinping and stuff, and how they kind of act on other sides. We saw it with aluminium in December. We saw it with more niche metals as well. As they sort of posture about what's going to happen, they start flexing their muscles on the parts of the supply chains that they do have strength, aluminium being a stronger point in China, the US being more reliant. So I think you'll see like sort of short-term movements like that, and then you'll see 50 juniors talk about how they've got this niche metal in their backyard and all these kind of things. And well, remains to be kind of seen. But I think there's a lot of talk, and you got to kind of wait to see what actually gets put into legislation.
I guess the interesting one, which has come out in the last week or so, is this project Stargate, that sort of $500 billion worth of investment into AI infrastructure. I mean, you guys have touched on that in interviews with a whole host of guests late last year around that driving, critical, minerals demand, as opposed to the, traditional EV theme we've seen for a while. I mean, it's a lot of money.
Mm. Well, it's potentially a lot of copper, a lot of
uranium
for this, because I was watching, I think it was CNBC the other night, and it was just the first question that always comes up about that Stargate was like, right, how are we powering them? So, and gas and nuclear are essentially the only ways for things of that scale.
It's a solder.
Yeah. Shitloads of solder.
I reckon every single miner can wrap that around their narrative and just plug in and play. You need every sort of electrification as well as energy type to get those sorts of things off the ground. And that's a bigger scale than we've ever spoken about. It's a bigger scale than most people have ever spoken about in a quicker time frame. So you can be suspect of how much of the money is actually going to go into the ground over what sort of period. But regardless, it's a huge kick up.
I think it looks pretty convincing it's going to happen. Remember 2 years ago, everyone was like, the metaverse is the next thing. That just died in the arse. But I guess this data center and AI thing looks pretty convincing that it's heading down that path, and it's pretty compared like how the variances in the whole EV, not bubble, but it was like a bit of a nickel bubble, really, like the whole nickel thematic that didn't come to fruition. But this looks pretty set for copper, energy, shitload of soldering for the tin. So we'll see.
Yeah. One point on the geopolitics stuff, it's like I feel like it's so hard to sometimes think of all the second order impacts and all that sort of stuff. But the general comment on the markets is like there's a lot of froth in parts of the markets, a lot, right?
Well, speaking of froth, actually, we did get a question from Nick on Facebook. Can we get a call on Fartcoin for 2025? Also, Trump and Melania coins.
Oh, that's just America's bizarre.
Yeah. But no, I think you're right, Trev. I mean, that's even in the meme coin space as a bit of a funny example. But yeah, no, just even more broadly as well. It's just crazy, isn't it?
I reckon on that particularly call, there's probably more chance that Fartcoin outperforms Trump and Melania. Just historically, celebrity coins have not done very well. Nothing against Trump or Melania, but but we'll see. But I do think there's a reflection to have on just the state of the market, because when things are really frothy, that's usually a predictor of things being pretty, like, a lot of turmoil. A lot of people are just like maximally deployed, but the reality is the best opportunities come in moments of like a liquidity panic or crash. Whenever a market crashes and all of a sudden some people have too much margin, or like funds blow up or whatever, they've got to sell everything and they're forced sellers, and those are wonderful buying opportunities. So I just think it's one of those years where, like, it's just going to pay dividends to have like some dry powder to deploy if those events or an event like that pops up. That's my feel.
I think I want to get my head around the timeline for these data centers and the projects, how long it's going to take. Because if they're so energy dependent, it's not going to be just uranium that'll be powering them. Like, fucking could be huge for thermal coal. Could be lithium for like extra storage. Like, could be a bit of everything needed to power it.
Look how cheap natural gas is in the States. It's insane. It's $3 or $4, like $4 when I last looked, Henry Hub. That is crazy. Like, everyone would be trying to use that first and then complement it with things like nuclear and other sources so they can meet the targets that they've put forward in these things, but they take a lot of time. Natural gas is a much sort of quicker and reliable means of getting your power if you want it soon. So I'm completely with you, though. Very keen to see the timeline of these builds. Yeah,
it could be diesel gen. He's powering it at the start, which is like a fucking shitload of oil, which is going to be the whole drill thing. What is it? Landman says got to be between, what is it, 73 and $88 a barrel for optimum conditions for the global economy.
Yeah, and look at Scott Besant, the incoming pick for Treasury Secretary. Super interesting guy. He's worked with Druckenmiller and Soros in his time in the hedge fund world. Ran his own hedge fund for a long time. And one of the pillars of his sort of policy he's putting forward is 3 million more barrels of oil coming out per day in the States. And that would be enormous. That would bring down costs. And obviously he's saying that to make industry hum even more in the States. We'll see if they can sort of get there. But that is one of the 3 explicit targets he's put forward, as well as the other targets on GDP and these sorts of things.
This Treasury Secretary, by the way, is a fellow that in the past has stated that he thinks the US dollar, US will default in its debt, that their reign as the supreme currency will end. Yeah.
Gold bugs want to get a hard on. Go listen to he did an awesome chat on the Capital Allocators podcast.
Yeah.
It's called Macro Maven. It was fascinating. The guy's got decades and decades of history in the game, and
his fund has plenty of gold in it.
I think what was Musk? Musk obviously puts it very simple, but what was he saying? Very soon the interest will be the same cost as the whole defence budget or something like that, just on the debt.
I think it might have just edged it out last year.
Yeah.
And that is a big military spend.
Fucking oath.
Well, speaking of gold, funny you guys talking about that. We've got Nathan from Twitter who asks, gold junior developers, which ones can realistically, in your opinions, fund and move into production themselves? Which ones will be taken out and which ones are pretenders? I mean, that's worthy of its own, bloody episode. But, we could perhaps look at a few company examples, but perhaps maybe the characteristics that you tend to see in the ones that can move into production themselves or, attractive for a takeout and things like that. You guys have any thoughts?
Ali, this is one for you, I reckon. This is your bread and butter.
I think
I'll have something to say.
Yeah, nice. I reckon the best performing producer last year, I think based on our chart the other week, was Catalyst in terms of share price performance. And they're growing, printing cash. I think they'd be looking for a deal. Like, would they maybe look at Bright Star for the Sandstone, because that's going to need a lot of capital to get that, because that's potentially not a bad hub coming up for some big pits, but it's going to need a plant. Likely need a plant. Makes sense to put a plant at the Sandstone project. So, yeah, I think Catalyst might be looking around. Like, you know, they're Meekers down the road from them, but just don't know if it's got the long-term scale.
We touched on in our first week back the Bullabulling deal. That'll be trading again in April, a few years away from production. It'd be a developer with an asset, just need to go through the studies and everything. But more generally, those kinds of deals have the assets that, to be honest, are
off your radar.
Completely off my radar. I had no idea about it happening. They're really interesting ones, and I'm sure there's more than a few that people are working on in the background. But yeah, very keen to see how that trades. I'm sure it'll be interesting when it comes back online.
I think two things I've learnt, particularly from last year as well, is as far as the speed and the sort of most streamlined path forward you can get from, you know, being a developer to a producer, I think, is having optionality and having your permitting under control. Just those having those two things, I think, so important. You know, just it's times to get, you know, MLs and then native title agreements and environmental approvals, especially if you have to build a processing plant and things like that. They take a lot of time. And optionality, I mean, yeah, I could do it myself. Yeah, I could get taken out by, you know, a big neighbour down the road. Yep, I could do this. The more optionality you've sort of got, I think, a bit more firmer ground to put your 2 feet on and go, actually, no, this is how I'm going to maximise the value out of, you know, this asset, this company sort of thing a bit more.
I feel like you're leading into an MMS plug or something there.
Yeah. no MMS plug today.
One more that kind of comes to mind, not a classical developer, but WAF, they're building Kiaka. That's going to be producing in half a year's time, and they're no longer trading at the level they were when they just had Sembrado. But I mean, in share price, they did a capital raise and everything, added sort of 60, 70 cents from the level they kind of were. But there's a step change again as they start producing over 400,000 ounces in probably a year's time once things have ramped up and everything. So that's one I'm sort of watching, obviously with the massive caveat of risk in the area that's in some countries heightened in recent times, but that's the opportunity that throws up for other people.
You think like the scale premium, or like the fact that they've got 2 operations?
I mean, even if they're getting marked on the same sort of cash flows or whatever that they were, going from one asset to doubling that, way more ounces coming out the ground, the cash flow jumps up substantially. Yeah, we'll kind of see in time, but I think people have definitely been risk off in West Africa over the past year, and I think that's an opportunity for other people that can play with that sort of risk.
Ding on that one for me.
I reckon now we're going to enter an era of cash takeovers in the gold space.
Cash takeovers.
I mean, if you just like look at the lay of the landscape, the gold miners are increasingly unhedged, cash generative, and sitting on large cash balances without growth projects. It's going to be competitive to buy stuff, and we haven't seen cash takeovers in a fair while in the gold space. I expect that to come back this year. I also think that there will be some really good opportunities for larger gold miners to sell assets in this kind of market too, for them to like rationalize their portfolio, maybe sell some of their higher cost stuff because they'll get really good value for it. And there are now all the mid tiers are really cashed up to pay up for maybe the not so best asset in the larger company's portfolio.
I think Newmont's a good example of that over the past 6 months, just bang, bang, bang. I mean, they would have been working overtime, but just the speed at which they knocked out all the non-core assets. And I think by and large they were getting more money than consensus was pegging it for.
Yeah. Single asset producers, I think, are a bit vulnerable too, because they're somewhat discounted because they're so much more exposed to single asset risk, and maybe they'll trade skinny enough that people will find value there.
Okay.
It'd be interesting to see if Goldfields gets active in Australia again. If they sort of just stick to what they've got, or they divest or invest, because there's definitely a lot of options for them. And Anglo Gold Ashanti I still think, with the cash that Regis is generating, and you look at the deal that Greatland got off Newmont, if Regis could pull 100% a trop out of Anglo Gold Ashanti, AGA, which they would have first right on, that'd be a big play for them. And because there's a lot of future there once that, a lot of underground potential there after the sort of pit finishes in a couple of years. So
that'd be worth a lot of money, hey? That'd
be big. But do you reckon if you're going to get the best deal possible, you probably get it out of a big company than a small one?
Especially if you've got the preemptive. Yeah, it helps a lot. Yeah, but they paid $900 million for 30% when gold price was like 3,000 an ounce, I think I want to say.
Yeah, I'd be interested to see, but a lot of that was probably paying for the big pit and everything. I think if not as much is proven up underground, and it knows that there's going to be a lot more capital to go into it with a downsized and cutting the mill in half, it's like, well, whether they might be able to get it a bit cheaper because AGA mightn't want to put the capital in. Not sure.
What do you reckon on Goldfields? More, less, or sort of equally involved in Australia in a year's time?
It's just so slow moving. You don't know. It's I think it's a pretty pivotal year for Bellevue. If they're gonna because the gold's there. It is a freaking high grade mine. It just, as I said, just needs that reset or ding 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 as well. But it's just whether someone will look at this pricing environment and think, 1.5 bills, we'll pay that, or we're going to wait for a bit more distress if they can't pull a couple of quarters together and try get them for 1.2. Not sure, but I think I reckon that company would be amenable to it for a liquidity event for the major holders. BlackRock a bloody 15% shareholder now in it. So I think it's going to be, they'll be interesting this year.
Yeah. We remember Goldfields, they were revealed to have tried their luck at getting hold of Karora subsequent to Westgold's. I think the scheme implementation deed was signed, but they tried to, they had local bankers and were trying to get hold of that.
They're going for a site inspection.
Yeah, well, the scheme, the information circular revealed that they lobbed a bid at a better price, but more conditionality, and they did have a change of management a bit before that. I think maybe 6 or 8 months before that. So, yeah, my gut is that they're much more amenable to doing things in WA. Not that we've seen it yet.
It was interesting in that region. I just saw announced today the new non-executive director for Pantoro is Stuart Matthews from Goldfields. He was one of the senior Goldfields
okay.
people. So then there's there've been the talk about potentially Westgold Pantoro with that sort of consolidating that southern Goldfields region a bit. So who knows?
Who knows? We're going to change tack of jurisdiction and commodity now. So we've got Palm Tree Capital, an ASX commodities investor from Twitter, asking about Indonesian mining. So Indonesian mining, in particular ASX listed companies, massive resources of gold, nickel, copper, low cost environment, but still close to Australia. But there's still risk factors around Indonesia, and it's growing rapidly. An ASX commodities investor asked, Nickel, what's your outlook by mid-year given Indonesia scaling back production in conjunction with the various operations that were mothballed last year?
Close to Australia, but a very different jurisdiction.
Yes.
Yeah. It was interesting to see, I think over the past week or so, that they were talking about giving out less permits, making a bit less happen in the nickel space so that, they can stop the just huge boost in supply that's come out over the past few years. So they want to find a price level. I think they're just playing a balancing act, right, where they can disincentivize anyone from doing any more production around the world, but get the biggest bang for buck that they possibly can. And yeah, so much money has gone in. It's already sunk there. The nickel's going to be pumped for years and years and years. As for the other commodities you mentioned, they'd obviously done a heap of work in copper too. They've forced Freeport. Freeport spent 1.2 billion US this quarter in capex,
Jesus.
mainly getting the
Smelter.
smelter at Grasberg that they are forced to do because they're no longer able to export just concentrate. So they need to go a bit further downstream. Very similar to what we saw with nickel. Indonesia wants to get more bang for their buck across the board there, and Freeport weren't going to walk away from Grasberg. So it's a balancing act. Lots of other countries have tried that unsuccessfully. They've managed to do it okay.
When you have enough of the market or whatever, you can kind of do it too, right? Like Guinea's the other example who are following a similar path in relation to the bauxite, add more refining, smelting in country even, which they're going to be able to do. And it's actually a good thing for the miners, strangely enough, globally, because you have a surplus of refining and smelting capacity, which means like lower TCRCs on you. Yeah. Which means you bank a bit more of that margin.
Do you reckon Freeport's going to get active? Like, they produced 400,000 tonne of copper this quarter, and has said trade at such a bloody good multiple, good paper. Do you think they're going to? They never really get talked about for copper acquisitions. It's always like BHP, Rio, Glencore, and the names that get thrown around. Like, does Freeport?
Yeah, I think it's a worthy conversation. Grasberg's unpalatable to Rio and BHP. Just the fact that the tailings run off into the ocean down the mountain.
BHP got good history with OK Teddy. Not sure how you say that one, but
Teddy.
Yeah.
Teddy, yeah.
And Rio had the original pseudo royalty on Grasberg itself, which they had to divest tragically because of the pushback from the tailings of the operation.
Yeah, I mean, remember we spoke about last year. Norges wouldn't invest in them because of their interest in Grasberg.
Yeah. But do you think Freeport will invest in will you see them pop up more in South America and stuff?
I'm sure they're looking at it as much as anyone, and potentially they've got more richly valued paper to kind of do a deal with, given they get all these kind of generalist funds and all these sorts of things. But I mean, I'd be talking way out of what I kind of know.
Didn't they used to own 10K?
They sold it in 2016.
Imagine if
because they did all these oil and gas deals at the beginning of the 2010s, almost went tits up in 2015-16 when every commodity came off, and they were fighting for their life and had to sell some really good assets. They owned it with the Lundin. They both sold out.
Yeah. But yeah, it's a good one, Matty.
Very interesting. So we've got Ian from Facebook asked, how to spot lifestyle companies? What are some good rules of thumb or sort of screens or red flags that you guys like to use when you say looking at a company, you're going through a quarterly or something, they go like, this doesn't smells too right, probably a lifestyle company?
Too many corporate videos and podcast interviews.
High sort of amounts of related party transactions. They're not all bad, but just look into the details on them. If there's, hiring your brother's firm to do this, your uncle's firm to do that, those sorts of things, just look into the weeds there.
Yeah, if you own a junior and it's in the business of exploration, you're owning it because you expect a catalyst to move its share price from where it is now. You're fighting gravity because the company has a burn rate, and that burn rate is its overheads to keep the lights on and pay all the bills and all that sort of stuff, which means that a couple times a year they're going to knock the door for new funds from investors. And if they're a very small company, then sometimes the dilution is so extortionate just to keep the lights on raise. If they're a $5 million market cap, they've got to raise 2. That's a lot of dilution, right? If they've got to do that twice a year, quickly your 1% interest in the company becomes like a 0.1% interest in the company just because they've diluted the shares so much. So what I think you really should be looking for is like, are they doing anything to get to the catalyst you're expecting them to do, or are they simply just dormant? Like, are they there's not much work happening. There's not much news flow. There's pretty substantial overheads, which are going to result in the need for new capital to come in. If they can manage the capital spend, like if they can manage the overheads, then that's not so bad a thing. If they've got like decent cash and they're running things really skinny, then you can wait a bit longer if you've got to wait for a different kind of price cycle for the catalyst to come.
Yeah, and I think I'll caveat that news flow with planning this or thinking about this, and you know, people you see a lot of companies put announcements out like, you know, about that sort of stuff. It's like, okay, but like, are you actually drilling on the ground? Have you completed a geophys survey? Have you actually done all of these things? As some companies just shit me when we're thinking about this, evaluating this, which look, you have to do. But if that's the only news flow, and then you've got, like you say, Trav, this corporate spend just going on in the background just to keep the lights on, it's frustrating. That's for sure. But yeah, looking at in the quarterlies, it you know, does split it out, you know, corporate admin spend, you know, exploration spend, you know, all that too. So you have periods that will ebbs and flows, but if it's, you know, pretty consistently very minimal on the operational activities front, it's probably worth looking into. That's for sure.
Yeah, what are you getting for that burn rate? You know.
Yeah, that's right. This one's for you, specifically for you, Matthew. So this is from No Pants Vance from Twitter. I will flash up his question on the screen, but I think the crux of what he's trying to understand is, how does ore body geometry, so you know, the shape of, you know, the blob of metal that's in the ground, how's that important when you then go from, say, like a resource definition stage to go, okay, now we've got to rip this thing out the ground and, you know, build a pit or build a, you know, underground mine that wraps around it. You know, how can the geometry affect the engineering side of things, given your, you know, sort of previous life experience in that world?
Oh, I'll try not to blab on with too much shit. But open pit wise, like if you got to start with a pit, you know, the more vertical the ore body, the sort of, you can't have a pit for as long, because the deeper you go, the more stripping is required to sort of follow that down. So you look at, you know, some of the great pits. Look at Capricorn, Carlawinda, like it's just pretty much the pretty flat plunging sort of ore body that the pit just follows, and, you know, low strip at the start, and they just keep following it down. It's obviously very consistent and good continuity, and like that's why they've made good money. So, you know, Mount Gibson will be different. Like that's, you know, vertical. You see that there's not big, massive pits. They'll be going underground a lot quicker. Then I guess when you do get underground, it's the dip of the ore body is the biggest factor at play. So obviously it's nice having a vertical ore body is just easy, because it's just, you're not, as soon as there's a bit of angle on it, you mine the stopes to that angle, but that hanging wall, the more angle, the more chance you've got of that falling in and diluting the grade. So, you know, your simplest mines are like your Orebanda for Davyhurst, or Ding 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 as well. Just vertical, like Daisy Milano, that was like thin and vertical, but it was a lot faulty. Like that was that created a lot of issues trying to stay on the ore body. But just nice vertical, just follow the vein, just nice and simple. That's what a lot of Northern Stars narrow vein mines that they've had over the years were just like that. So and then so you look at the mines around like your Leonora, where they go down, instead of being 90 degrees, they're like, you know, 40 degrees, 30. So Gwalia is like 40 degrees. So it's obviously dilution, controlling the dilution becomes a problem. Recovering the ore on the footwall, because it's one thing controlling the dilution there, but when it's laid right over, I think the natural angle of repose for dirt to run down a hill is 55 degrees. So essentially, once it goes past 55 degrees and it's flatter, the ore will sit on the footwall, and you either have to wash it down, or you have to take more angle out of the footwall and take waste to get to that, 55, 60 degrees to get it to rill so you can bog it. And then the more it dips over, you have to do a lot more you have a lot more development per vertical metre in the ore drives, because if you had 20 metre level spacings but it's dipping at 45 degrees, it's like a 30 metre drill hole to reach the other level. So you have to condense the levels a lot closer. So, and which could be, it's less decline development, but it's a lot more operating development too. But it's just a bit more difficult. And then, so that's dip. But then, look, Gwalia have been doing it for friggin', 1,000 odd metres vertically, 1,800. I don't think it was like that the whole time, but they've, once rinse and repeat, they get it down pat, and they've obviously got a way to recover it the best they can. But then proving up the ounces, the other one is plunge that we talk about, the shape. So Gwalia has a big plunge, Paulson's had a big plunge, and that means there's your dip of your ore body looking this way, but then if you spin around 90 degrees, it's where the ore body's going.
I'm also is it just going like this, or is it turning around?
Or is it going that way? So like Agnew, Wahroonga for Goldfields, that was like just dead vertical. Like it's just a decline that just spiraled next to it. Paulson's, for instance, has a big plunge. I think Firefly's one has a big plunge. Gwalia has a big plunge. So what happens there is to actually infill drill as you go down to get the confidence in the ore body becomes more difficult, because if it's got the big plunge to drill 300 metres below, if you were just drilling from next to the ore body, to get the angle on it is impossible because it's so far away. So you've got to develop these long exploration drives to get over the top of it to get a better angle. So that obviously costs more, but then it's trying to get the geological confidence is what drives your guidance for the next year, because you've got to know pretty bloody close what the grade is. So you tell the market we're getting 200,000 ounces, but if you're out by a factor in the grade, it doesn't come out of that number. So plunge is another one, and then that's why Gwalia doesn't have a shaft in it, because they never got to the point. It obviously kept going and going, but they never got to the point to say, right, we have enough confidence in the ore body down here and we're going to pick a point to put the shaft in here, because the ore body's plunging. You can't extend the shaft later on because the ore body keeps getting further away from the shaft. So you have to pick a point to put it in. There you go.
That was actually very interesting.
10% of bloody everything you'll need to know there.
Yeah, but the takeaway basically being that I sort of got from that is basically the ore body geometry, depending on what sort of, if you're developing as an open pit or an underground, can impact basically your material movement, and the more material you're having to move, the more that's going to cost.
Yeah.
And also the logistics that's involved with, more difficult material movement and angles and things like that.
Well, and geometry is also, if you look at where the location as well, because let's look at Spartan. Spartan's got Never, then, Pepper's right next to it, then is it 4? They got 4 pillars sort of upstrike from that, and they're sort of all lined up next to each other, and they've got the decline coming in from the pit, and they'll just go past each ore body and then keep going down, and sort of they can piggyback off the infrastructure, like off the ventilation, the pumping, the power, as they sort of go down, and they're accessing multiple ore bodies all from sort of the one entry point, from the one decline. Whereas Bellevue, for instance, like Bellevue's got, cracking grade, cracking ore body, but there's a bit over here, there's a bit over there, there's a bit bloody behind me. So you've got sort of independent mining areas accessing all these places which need independent infrastructure, like pumping, ventilation, power, and you've got to sort of spread it out everywhere, which is, you would anticipate why they're, struggling to get the ounces out of the hole, is managing the complexity of the constraints of infrastructure. So once you pile all that together, there's good bits of it and bad bits of each of it. You'll figure out is it good or not?
Yeah.
or you have a vote on whether it's good or not.
All right. No, that was a very comprehensive one there. Like that.
Well, I was only there for bloody 14 years and I know about 10% of what I need to know. So it's just, that's why when someone's been mining for 30 or 40 years, you friggin' listen to what they have to say.
Absolutely.
'Cause,
Trav, we got one from Nick Huntley, who asked STAM. So this is, for those who don't know STAM, as Samuel Terry Asset Management. In their last quarterly noted they're now holding a gold producer. Who do you think it is?
Wow, I actually did not know that. I didn't read the last quarterly. I read the one before that. That's a great question. Who would stand by there? They didn't name it. They didn't name who. Yeah.
Apparently,
Don't know.
according to Nick, no.
Knowing those guys, it'll be something funky where there's a bunch of latent value that the market's not quite seeing. Like they've got a good eye. Those guys, not entirely. They hold a bit of gold bullion as well. JD, I could be wrong.
They did last time I read one of their reports.
Yeah.
I'm pretty sure.
So I don't know, Ali. I don't know.
It'd be something left field, wouldn't it?
It would be. It 100% would be left field. They just find value where you usually just look past it.
Value and sort of catalysts where they can kind of make something happen in a way.
Catalyst is a big one. I think they are exceptionally good at creating catalysts.
Yeah.
If anyone wants to look up NAM on the ASX. It's Namway Cotton.
Oh yeah.
Check. Just go over the series of that company's announcements over the last 12 months, and I think you'll kind of see the value creation STAM are capable of creating for shareholders.
There was an announcement almost every week, so I'll have a fair bit of reading
Yeah.
for you.
And I'm going to do one last quick round table. I've got a question for each of you. Matthew, you played a lot of golf over the summer break.
I did.
Tito Trades from Twitter asked, what's Matty's handicap?
Oh, it's 15 I got to, I think, sort of.
Sort of.
Yeah. No, I think I hit 17 the other day, playing on 15, about 15.
Very good.
Bloody volatile. It's like, what stock would I compare my
It's like your portfolio in general.
golfing to? Nah, but the shells, I ain't get in at the bottom. What I think's the bottom. What would you compare it to?
A certain uranium company you hold?
Maybe. Yeah. It's I don't know. It'd be one day the driver's going good and the irons are fucked. Then next day the bloody driver's bloody shit itself and I'm smashing the irons, and then usually the putter's fucked the whole time. So it's like, good fun. Anyone that wants a game on a Friday from going forward, hit me up.
I love it. Actually, I had, on a separate thing, I had to think about the other day, we were talking about what's like the finance or the West Perth equivalent of Word on the Decline, and I think I've thought of it.
Oh, what is it?
I think it's the WhatsApp on Hay Street.
What's up on Hay Street?
Yeah.
That's good. I love it.
So that can be for finance goss. We can do WhatsApp on Hay Street.
Oh, yeah, because everyone's like, WhatsApp. Yeah. Send anything on WhatsApp, it's safe.
Didn't those guys, the guys, one of the biggest insider trading scandals in Australia? Like, don't worry, it's all good. We're talking on WhatsApp.
And that's what they wrote in WhatsApp.
Yeah, fully encrypted. And then you got the Australian Federal Police just reading it all. Oh, it's golden.
Crazy. JD, what was your favourite book you read over the summer break?
Oh, I'm not sure anyone's going to chase me up on this one, but I read a book called Kaput. I spent a bit of time in Germany, got family and stuff from there, and it's on the struggles of the German economy going forward. We've spoken about the energy problems, reliance on Russia, and all these sorts of things. So it was seriously interesting talking about a lack of investment in appropriate industries, a lack of sort of resilience in critical parts of your economy.
Yep.
And getting a bit sort of sidetracked by certain ideologies and those sorts of things. It was really interesting.
Awesome. And finally, Trav, what was your favourite dog-friendly pub you visited over the summer?
Oh, I didn't go to any dog-friendly pubs over. Oh no, I did. Yeah, I went down to Bridgetownish area. There was a cider cidery in Nannup. There's like
very
Nannup?
cool.
No, it was Bridgetown cidery. Yeah, that was wicked.
Just on the outskirts of town there?
Yeah.
Yeah, I went there years ago. It's
Yeah.
an awesome spot down there.
Yeah. So it was good. Took once there. Yeah, it's good.
Love it. Oh, very good, guys. Thanks for answering all those questions from the money miners on the fly. That was
you
really
hosted so
interesting.
well, GC.
No, I don't
You're
have to do much.
such a
I
good
just
bloody
read
Q&A
things out.
moderator. Don't take
the,
me spot at conferences. Rightio, there we go. Well facilitated. GC, you could just dead set consult yourself around Perth and the Greater Australia being a Q&A facilitator.
Oh, I loved it. It was great
So well
fun.
done. So well done.
Learned
What a-
heaps too. So
What a job we have.
I know. If today's
We get
anything to
paid-
go by,
We get paid for this.
it's amazing.
Can't believe it.
Go to the mining industry.
Oh, mate, pay yourself a favour as well and get a friggin' underground operator's ticket. And you can pay, it's effectively paying yourself $100 because you get $100 off using the code MOM100. Link it is in the show notes. The greatest underground conference in the world, April 7th to 9th in April in Adelaide.
Who else we got to thank?
The
Matty?
greatest open pit mining contractor ever, Mineral Mining Services. Greatest camp builder ever, Grounded.
Go
The greatest source of keeping the rock up underground, Sandvik Ground Support.
Yep.
Definitely the greatest insurance brokers ever, CRE Insurance. K-Drill, like, you could say the greatest driller ever, but you would say Ryan O'Sullivan is the greatest bloke ever.
As well.
Yeah, Saltbush Contracting, the greatest bulk haulage specialist and the greatest do any shit job specialist on your mine site, Saltbush Contracting. Swick, jeez, possibly 17 million drill meters.
That's a lot of meters.
Possibly the greatest underground diamond driller ever, I'd say. Quattro Project Engineering, based on everything they've invented, just the greatest engineering firm ever. Cross Boundary Energy, well, Tim Taylor's the greatest bloke ever that has provided independent power solutions. And I don't know, GC, you're the greatest, just the greatest sidekick on a bloody podcast ever, I'd say, this week.
Good work,
You've been
Matty.
the greatest partner I've had in the podcast this week.
This week. Your only partner.
Have a good weekend, Money Miners.
Hoodoo Money Miners.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.